Most traders spend their time analyzing technical or fundamental analysis, and though these are very useful, they don't determine long-term consistent success. Long-term consistent success consists of 3 steps. Unfortunately, most traders are interested only in picking the right spots on the chart to enter. It limits the number of trades, and without implementing the proper money management and trading psychology, the long-term consistent success is going to be hard to achieve. You can have the best strategy in the world, but if you don't handle losing trades properly, if you don't size your positions properly, in that case you become highly vulnerable when the market goes just a few points against you. It's important to understand for a trader that in trading business, losing trades are part of trading. You're going to experience losing trades. As a developing trader especially, you're going to experience a bunch of losing trades. And it would behoove you not putting unrealistic expectations to achieving high win percentage. 90-95% plus win percentage is extremely rare and only happens to best of the best traders. And even then, you're most likely not going to be able to mimic the exact trading results. Everybody's mental makeup is different. Everybody comes from a different background. Everybody's trading journey is completely different, and you cannot mimic other traders' results. Everything starts with one single losing trade. Because if you're not able to handle losing trades properly, if you don't follow the rules of your strategy and your money management system, doesn't matter how successful the strategy is, if you don't follow the plan. For that reason, you need to find a way to find losing trades acceptable by making proper position sizing. A lot of times traders experience multiple losing trades in a row, and they think themselves that they need to make it up so much to get even break even that they might as well just keep going, keep digging. I might as well blow my account and start over. And this happens often. Traders a lot of times blow their account like this because they don't have predetermined set of losing trades when they're stopped trading for the day and they live to trade another day. Don't blow your hard-earned capital on one single day. This is a common boom and bust cycle when traders make 7 days consistent profits, small little profits, and they give it all back in one single bad day. Then they make week consistent profits and they give it back on one single day. Boom and bust cycles, nothing to do with the strategy accuracy. Even traders, they blame the system. It has nothing to do with the system, nothing to do with the market. Market is not against you. You didn't handle losing trades properly. You probably got tilted and it resulted in blowing the account. Number one way you're going to protect yourself is you're going to select the proper amount of capital you're willing to lose. The risk capital is an amount of money that you would be comfortable losing, and if lost would not greatly affect your current financial situation. A lot of traders find a fancy strategy on YouTube and they instantly picture themselves creating a lot of money, and they don't even take into consideration the possibility of blowing the account. Your starting capital should be only a small part of your net worth. That means you should not be borrowing money from your family. You should not be withdrawing the saving accounts. It's not the money you pay the rent with. It's not the money you repair your car or buy groceries. It's only the money you saved up on the side that you don't care about if lost. Before you go live, first you need to prove your profitability on sim. You cannot go live unless you've proven you can create a consistent money for a few months on the simulator. You don't have to do it for years, but for a few months at least you need to prove you can do it consistently. A lot of traders, they jump in too quickly thinking that they're ready. They're blowing their hard-earned money, and it would be better off if you just waited a little bit more, been a little bit patient, and then saving the capital once you're ready to trade live. What should be the starting capital for a scalper of S&P 500 and mini futures? I would recommend $2,500, $3,000. You're going to have enough funds for 20-25 trades. Some traders recommend starting with $10,000, and it would be great if you can acquire that amount of money to start with. You're going to be risking only 1% per trade, but this is enough money for you to have enough funds for 20-25 trades. You cannot start with $1,000 account, even though margin is $500. You're going to take few losing trades. You're going to be approaching the $500 margin call, and they're going to affect you psychologically, and you're not going to be able to make money. You're not going to be able to recognize the proper opportunities in the market. You need to have room after you're losing trades. You need to be comfortable and psychologically stable. If you're going to blow your $3,000 account, what makes you think that you're not going to blow $10,000 account? If you can't make money within 30 trades and you're going to blow your $3,000 account, that is for sure obvious that you're going to blow $10,000 account. Save your money. If you can't make money with account like this, go back on simulator, prove your profitability there. After a few months, come back and try live. common rule in trading is that you should be risking 1 or 2% of the capital per trade. And this is the ideal scenario. You can risk a little bit more, but you just have to make sure that the total dollars at risk are within your comfort zone. You cannot be risking 20 or 30% of your capital per trade. Would you be okay with losing 60% of your beginning balance on just 3 losing trades? You wouldn't. And yet a lot of beginner traders approach trading like this. I started like this. I started with a little over $1,000. I thought it was nothing. I'm okay with losing this. I thought I was going to make few winning trades right off the get-go, so I have a little bit of a cushion. What ended up happening, I had 2 losing trades. My first trades live were 2 losing trades, and I instantly realized how close I am to the margin required. I instantly realized how low amount of trades I can take before I can close my account. And that, of course, affected me psychologically. And if you're worried about losing money, that will affect your trading and you will lose money. You have to trade so small that one single losing trade is completely insignificant. Trading is not about trade by trade basis. It's about series of trade. You have to risk small. You cannot get shaken by one losing trade. If you feel any sort of jitters after you lose one trade, that means you're trading too much or you're too much emotionally invested. Every trader should limit the number of trades per day they take and limit the number of losses per day. If you take 2 losing trades in a row, take a break, take on 15 minutes, clear your head, get back. If you take a 3rd losing trade, close it for the day. It's not worth it, keep pushing it, because a lot of times you will close it, come back next day, market is going to be easy, it's give you easy setups, you're going to be in the zone, you're going to make all the money back and then some, and you would be saying to yourself, wow, I could have blown my account so easily had I just waited one single day. That happens a lot. It's never worth keep digging the hole. I know that a lot of traders, they have a few losing trades and they think to themselves that it takes so long to make the money back that they might just well blow the account and start over again. No, with proper money management system, we're going to talk about if you have good risk to reward ratio, you're going to make the money back easily. You need to limit the number of trades per day you take as well. You cannot be too greedy. It's about finding the balance. If you have 2 or 3 winning trades in a row, I recommend calling a quit for the day. And on a high note, if you have 3 winning trades in a row and you take 1 losing trade, you're probably going to take even more trades because you picture yourself with a 3-0 winning day and you take 1 losing trade. So you want to make a little bit more money. And if another trade is a losing trade again, you're getting close to break even. You're getting now completely frustrated. Had you just stopped with 3-0, that would have been much better. Every single time you place an order in the market, you're exposing yourself to risk. If you are 2 or 3-0 for the day, don't push the luck no more. Of course, if the day is extremely easy trend day, or you can read the price action correctly, of course, if you're an advanced trader, you can take a little bit more trades, but most traders are better off if they just don't be too greedy and take their money and start trading next day. Always set the stop loss. Stop loss protects you against yourself. By putting stop loss in the market, that tells you about yourself that you're accepting the possibility that the trade may lose. By every single trade placed in the markets, there is a possibility that this trade may lose. And for that reason, you need to accept the risk and put the stop loss in place. Stop loss should always go 1 tick below the signal bar, and you should never move the stop loss. If you keep moving the stop loss, what does that tell about you? That means that you're refusing to admit you're wrong. You're afraid of losing the money and taking the hit now. You want to give it a little bit more room for pullback so you can ride it out and the market goes in your direction. That never works. You will blow your account like this. That's a horrible money management system. You're going to need 10 more trades to make it up on one single stupid losing trade. Always set the stop loss order. Never move the stop loss order and let the trade play out. If you have a losing trade, you learn from it and you study from it. Traders should place their stop loss 1 tick above or below the signal bar they're entering. The reason because is using the price action structure that helps you protect the stop. If the market reverses on you, your stop loss gets taken out and you made a bad call, you're going to make it back on the next trade. You cannot move the stop loss. You cannot tweak it and put it in the middle of the bar because there's going to be a noise. There's going to be a pullback and you may get stopped out prematurely even though the trade ended up working. So on the paper, you lost money, but when it comes to strategy accuracy, your strategy produced a winning trade. Bad money management system is going to make you lose money even though the strategy accuracy is working on your side. You always put the stop loss 1 tick above or below the signal bar. What to do if stop loss is way too big and you're uncomfortable risking that amount of money? Scale down the number of contracts to a number you are comfortable with risking. Or you can use limit orders. Enter at the close, enter further back into a bar. This is the advantage of limit orders. You can decrease your stop loss or you can also increase the possibility of your target profit being hit. If you trade regular ES, take the setup on micro and minis. In worst case scenario, you can skip the trade, but if you skip the trade, always mark the setup. Always picture yourself taking the entry. You want to get the experience. You want to picture yourself taking those setups according to the strategy. Always mark the setup and act accordingly as if you would have taken that trade. When can traders exit their positions early? Beginner traders should never exit early from their positions. Beginner traders should always let the position run. If it's a losing trade, learn from it, because you don't have enough experience to recognize that the market context is changing. And a lot of times beginners, they exit their positions and the trade ended up working, and they're making their learning process even longer. That way, never exit the position early if you're a beginner trader. Advanced traders can exit early when it's a congestion or consolidation period. If you enter about this bullish bar, this is your entry, you put your stop loss one tick below because you don't want to move your stop loss. You can get stopped out on the noise. After 1 hour of market not giving you clear direction, this is a chance for a trader to pack his bag, take the money at break even, and not risk anything. Because if market cannot make a clear decision where it's want to go within a 1 hour, that tells you that anything can happen in the market. It can break out at either direction, and your first intention, your first analysis was a little bit off. Money management for a scalping trader. Scalp trading is about taking multiple trades per day for a brief period of time. Swing trader can make money on a 50% win percentage because he cuts his losses quickly and he lets his profits run. As a scalp trader, you're quickly in and out of the market with small profit and you don't care about the direction afterwards. There's a huge advantage that you don't have to predict the market consistently. You can be just right for your small, tiny position and you're out of the market with your profit. What is the minimum scalp size? In stocks should be 10 cents. In ES should be 1 point, in Forex should be 10 pips. However, your goal is to always have 1-to-1 risk to reward ratio. A lot of times in scalping, this is hard to do. A lot of times you risk 2 to get 1, but if you risk 2 to get 1 or 3 to get 1, you're going to have insanely high win percentage, which is going to put a lot of pressure on a trader. The goal of a scalp trader is to find the perfect balance between being quickly in and out of the market and not leaving a lot of money on the table. You cannot afford to take micro scalps. You're going to get kicked on the commissions. You're going to have 1 losing trades that will wipe out 10 winning trades. Institutions can afford to scalp 1 or 2 ticks. Regular retail trader most likely cannot. Why do I scalp for 2.5 points in ES? Starting out, I used to scalp for 1 point because this is the most commonly recommended target profit. But I ended up having days like this. I had 3 winning trades. I took 4 ticks on one, sold 12 ticks winner. I took a 1 losing trade that was slightly larger than the average 8 to 10 ticks, let's say 12 ticks, and I ended up being break even losing money because of the commissions. So I was being 75% right for that day. So the strategy is clearly working, but I'm not making any money. If anything, I can even lose money on the commissions. And that put immense amount of pressure on me, because if you have this happen, what will that do to you? If that you will be forced to take the next trades. You will jump the gun because you want to make the money back. If 1 losing trade can wipe out your 3 winning trades, you will be forced to take the next trades quickly because you want to make the money back that you already made, and that will force you to take developing trades that are not even there. Also, this will make you fear losing trades tremendously. As a trader, you have to accept the losing trades. It is inevitable. Trading has an element of randomness. Patterns repeat consistently, but not on a trade by trade basis. And if you're afraid of losing money, that means that you're going to skip the setups and you're going to only take the setups you think they are the best. But if you're afraid of losing money, you will end up losing money. So the pressure is immense. So for that reason, when I adjusted my target profit to approximately reach to 1-to-1 to risk reward ratio, I knew that if I have a 1 losing trade, it means completely nothing. I can make the money back and then some on just 1 single winning trade, and that put me in a zone tremendously. I don't even think about losing a trade. Losing trade is just part of trading. It's completely fine with this. Also, if I used to backtest it, and I figured out if I follow my strategy perfectly, if I take the high probability setups at the key entry points, they easily 95% plus at least easily work for 8 to 10 ticks. And as a scalper, your job is to find the balance between being quickly in and out of the market and not leaving money on the table. So I didn't want to leave money on the table. Also, you increase the chance of catching a runner. because a lot of times if you hit 1 point target profit, the market will pull back, take your runner out, and then continue in its direction. But if you make your target profit a little bit larger, you will ride out the pullback, your runner is still alive. When traders are afraid of right off the bat going for 8 ticks, great transitioning phase is starting for 6 tick target profit. Because if you're used to scalping for 1 point and right now you find yourself sitting in a trade for a long period of time, a lot of traders, they can't handle that. They want to exit the trade quickly. They want to take the profit quickly. And this is why a lot of traders don't like really increasing their target profits, because they're too anxious. They want to take the profits now. They want to scalp quickly. And the longer they wait in the market, they feel like the odds are higher that they will not make the profit. This works short term, but long term on consistent basis, you're better off having a 1-to-1 risk to reward than going for 4 ticks. Of course, if you have high enough win percentage, you're a great trader. You can easily go for 1 point. It all depends what suits your mentality the best. But most beginner traders are going to struggle to keep consistently 75%. But with proper money management and the proper risk to reward ratio, you can make consistent money with 6 tick or 8 tick target profit. And if you trade other market than S&P 500 M&A futures, how do you identify the proper target profit? Well, you can use ATR indicator, or you calculate the average stop loss in the markets, and you will try to make the risk to reward ratio close to being 1-to-1. Here's a recent trade that I took. Second entry short of 2 key entry points, but I only went for 6 tick target profits because I wanted to have enough room to these lows. So price broke lower, filled my limit order, instantly pushed in my direction, and I made quick, easy 6 ticks. Well, this is a perfect scenario, isn't it? Well, it's not. This is very short-sighted, because what ended up happening, had I gone initially for my 8 ticks, I would not have been filled on the one single bar like this on the 6 ticks. I would have to ride this out. I would have to endure the discomfort. But what would have ended up happening, I would have made the 8 tick target profit right here, and my runner would have survived, because this is the initial entry, and you put your one swing contract, your runner, at the break-even position. You guys can see the break-even position wasn't hit. So I ended up leaving 11.5 points on the table. And this is what I mean. Scalping for small profit sounds good, very short-term, but in the long term, if you go for 8 to 10 ticks and you incorporate the runners, your runners have much higher chance of surviving with the 8 tick target profit, because you will not get stopped out on the initial noise. Of course, it is subjective, and it all comes down to your mental makeup. If you can make money consistently with 1 point, it obviously suits your personality. You're great at handling this. Great, stick to this. This is just my opinion, what helped me. As a developing trader, you want to start with one single contract, and after you've proven you can consistently create profits, you can start adding on more and more. Eventually, you can divide your positions into twos. 2/3 of the contract size is going to be your main portion, your scalp portion, and 1/3 is going to be your runner. You're going to maximize the profits the most, because as a scalper, you're mostly interested in short-term profits. You're not predicting the market, what's going to do in hours for now. You're just interested in quick, easy profit. But what can happen? Your entry can produce a substantial move in the markets, and you don't want to leave money on the table. And for that reason, you're going to leave one position open. You're going to scale out so you can capitalize on the potential profits. We're going to finish off with a comparison between stop and limit orders, and why I only use limit orders. Stop orders will allow you to never miss an entry, and this is a great advantage, because on limit orders, as a trader, you need to wait for price to tick 1 tick above or below your setup. You need to wait for the tick for the trigger, because the market may reverse and the entry may not have ever triggered. So you always need to wait for the trigger. Then you need to wait for price to come back and fill your limit order. And of course, it can happen. The market will rally in the direction and it will leave you behind. That can happen. It suits my mentality the best, that I'm okay with missing an entry. What I like doing more, because limit orders will allow you to decrease the risk. The further back you place the limit order, the smaller your stop loss is. If this stop loss is smaller, I'm losing much more money, and thus I'm able to completely remain focused and take more trades in the future. Also, there's a better probability that the scalp will be reached, because your target profit is lower and lower. And even though I go for 8 tick target profit, 8 to 10 ticks, if I use limit orders, it's still very mediocre or very minimal move in the market. So I can easily reach the target profit, and higher chance of catching a runner. Because the further back you place the limit order, the higher chance there is that you will not get stopped out on the noise, but you will miss a lot of entries. This suits my personality the best. I don't like using stop orders because I'm increasing my risk. There can be even a slippage on a stop order. If there is enough momentum in the market, you can have 1 or 2 tick slippage, even though it happens extremely rarely in the ES. So I'm going to see you guys in the next one. Take care, buddy.